Hello, Conrad. Great to see you. Thanks for taking time. Clariant has just released its second quarter 2025 results. So on the one hand, we see a significant step up of our profitability with the EBITDA margin reaching 17.5% now, 200 basis points up. At the same time, we see a decline of sales of 8%. Can you help us bring these two numbers together?
Yes, good morning, Kai. We were very pleased with how the numbers in the end have come out in the first half. If you look at the second quarter specifically, our overall sales were flat in local currency. So the 8% decline you refer to is measured in Swiss francs. And this is for us a translation effect. The Swiss franc appreciated 8% roughly versus all the other currencies in the quarter. So overall, flat sales in a quite challenging environment. What we were particularly pleased with is the step up in profitability. As you mentioned, 200 basis points improvement in profitability. That's a big thank you to all of the employees, also to you, Kai, who have contributed here, because that is a massive undertaking. It is a reflection of, first of all, the 175 million Swiss franc cost out program that we finished in the first half year. That sits fully in our numbers now. And we also started a second round where we basically have an 80 million Swiss francs cost out program, where we already saw 12 million Swiss francs in the numbers in the first half. So in an environment where we have overall flat sales, a challenging environment where the markets offer few opportunities for growth, we've been able to significantly improve our profitability.
Yeah, thanks very much, Conrad, also on behalf of the other employees. Now let's look a little bit at the details of our top line. So maybe starting with the strongest business unit, Catalysts. Here we recorded sales of 5%. What were the drivers behind this step up?
Yeah, a real good quarter in Catalysts when you look at the top line, as well as the bottom line, by the way. But if you look at the top line, we should put it a bit in perspective. In the first quarter, our revenue was down. In the second quarter, now we're up in Catalysts. There is the timing of orders that sometimes plays a role. In particularly in the second quarter, we had a fairly big order in syngas. By the way, this is a customer win, so that is a positive. But it did impact very much the revenue in this second quarter. So underlying what we see in Catalysts is a flat performance. We are bottoming out. Chemical production rates still are fairly low. So in Europe, we're at 75% capacity utilization on average. In the US, we're around 80% capacity utilization. In China, it's a very mixed picture. Historic low run rates. In that environment, to see our catalyst business bottoming out with a basically flat performance year on year expected for this year is also something that is in line with our expectations. What we really were pleased with is the enormous EBITDA margin improvement in Catalysts, again, also in the quarter, which indicates here in Catalysts as well that at the lower run rates, we actually have improved profitability.
Yeah, very good. So another business unit showed growth as well, slight growth. That was the plus 1% in adsorbents and additives. So what happened here in the different segments?
Yeah, in additives adsorbents, you saw a strong first quarter. What you saw was a bit of weakening in the second quarter, particularly towards the end of the second quarter. We highlighted after the first quarter that tariffs will not be good for consumers. They drive up inflation. Tariffs are not good for business. They drive down demand. And what you see is indeed a slowdown in consumer goods spending right now already. As an example, for us, key segments like consumer electronics, for instance, right now, projections for cell phones are for a flat year. If you look at furniture sales, slightly up last year, the beginning of a recovery. Now the projections are for basically flat furniture sales this year. Automotive global build rates, basically flat or slightly negative as a projection for this year. So what you see is this recovery that we were hoping for this year. It is not happening to the same extent. And you see that reflected very much in the additive sales that are tied to durable goods spending. Now, in adsorbents, it's a different picture. We very much saw in the first half a weakening in adsorbent sales when it relates to biodiesel and sustainable aviation fuel. What we are expecting there is a recovery and a pickup. This was very much linked to the incentive schedule in the US, which was put on hold temporarily by the Trump administration. Now the incentive schedule is back, will be back January 1st next year, and we expect a recovery in those markets.
That's great to know, Conrad. But finally, last but not least, our biggest business unit is Care Chemicals. Here we saw a slight decline of 2% in terms of sales. So what are the reasons behind that?
Yeah, in Care Chemicals, what we see is that actually there are some clear headwinds in oil services. As you see the oil price coming down, typically also that has an impact on our business. So the oil services business being down, our base chemicals business being down in Care Chemicals, those are segments, amongst others, related to construction. So these are the weaker segments, but we also see strengths. So we see strong sales in crop solutions, where we compare against a weak base last year. There was still a lot of destocking, but we see now the underlying growth back in that business. And very important, we also see in the premium segment in cosmetics, continued strong growth. There have been reports of downtrading in cosmetics. There is some of that, but not in this premium segment where you talk about age creams, where you talk about premium hair care products. That is actually showing continued strong growth.
Yeah, that's good to know. Conrad, coming back to the EBITDA margin, you already mentioned one of the key success factors were the cost programs. Can you also elaborate on some other levers behind it, like, for example, pricing and margin management in general?
Yeah, very important. So first and foremost, we finished successfully the 175 million cost out program. We started the new program, the 80 million cost out program, where we expect more than half of that already in our numbers this year. But as you mentioned, price continues to be very critical. So I also think that we can be very pleased with our pricing. If you look at H1, we are actually slightly up in pricing, which is very good in an environment where there's definitely increased competition for volume. There are competitors out there that want to fill their plants. We've been able to still achieve a positive pricing in the first half, which I think is a tribute to the true specialty nature of our products. They're truly differentiated, but also strong efforts and achievements by our commercial teams to really get pricing that we need.
Yeah, thanks very much, Conrad. Let's now shift the focus to the outside world, to our environment. What do you see as the key challenges at the moment looking at our business?
Yeah, the key challenge is a delayed growth. So what we basically said after our first quarter results is tariffs will have an impact on durable goods spending. And that is what we are seeing. We see a slowdown in a number of end markets, particularly related to durable goods spending. And as a consequence, we have lowered our outlook from the bottom end of the 3 to 5% growth local currency to now a range of 1 to 3% local currency growth.
Yeah, let's talk about that maybe. So we adapted our guidance overall, so there are some more factors. Can you elaborate on that a bit more, why we took down the guidance and what it means?
Yeah, we took down the guidance in terms of growth, but the most important element, profitability, we maintain our guide for a 17 to 18% EBITDA margin. So we really achieve a higher profitability level on lower sales growth. And that is an enormous achievement. If you put this in a bigger perspective, what we saw in 2023 is an EBITDA margin of 14.6%. Last year, 2024, we saw an increase in our profitability to 16% EBITDA margin. And this year, with our guide, we expect a further profitability improvement, a range of 17 to 18% EBITDA margins. So what we're looking at is 3 years of a consecutive significant improvement in profitability for the company.
And last but not least, our outlook also includes a statement on cash conversions. So how do you see that at the moment developing in light of the environment?
Cash conversion, the conversion from EBITDA to cash, an important metric for us. Historically, the company was not great at generating cash. What we see now is that we are achieving a level in our expectation close to 40% by the end of this year. If we will achieve that, it essentially means we've already achieved our midterm targets. That reflects a lot of good work on working capital management, much more disciplined spending on CapEx, but also the pickup in EBITDA helps.
Yeah, thank you for these insights. Maybe a final question, Conrad, if you allow. So what is your personal view on the trade deal that was now announced between the European Union and the US? So what is the impact for Clariant and the industry?
Yeah, well, it's good that there is a deal, that we basically now have off the table this scenario of 35% tariffs for goods from Europe getting into the United States. It's good that that's off the table, but the 15%, let's be honest, it's still a big number, and it used to be historically around a 2.5% import duty overall for European goods entering the United States. So this will have a slowdown effect on European exports. It is not a positive, and the chemical industry, as you know, is a very global industry. Historically, in Europe, 35% of the production in chemicals was exported. By the way, historically, 25% of the production in the US was exported. And if you look at China, it is actually less than 10%. So Europe has a vulnerability for basically reduced global trade. The US has that as well. What I think is positive, but it needs to be worked out, there is this zero tariff list. And base chemicals are being reported to be part of this to some extent. So I think what's important in the coming months is to detail out this trade agreement and to get as many as possible our chemicals on there, because in the end, chemicals are not finished products, they are intermediate products. So also for the US, basically raising tariffs on intermediate products is going to make their own industry less competitive. So my hope is for a detailed exemption list for a lot of the chemicals that we're trading.
So we end with a word of hope. That's very positive. Thanks very much, Conrad, for your time. Wishing you all the best, and we'll talk again soon.
Thank you, Kai.